Hi there. I'm John Thompson, lead advisor and founder at SMPL Mortgage. And today's Borrow Smart, Repay Smart lesson is going to be kind of on everyone's favorite subject. And we're going to be talking about divorce, cash flow, and maybe some ways to mitigate some of the impacts of taxes during that kind of situation. So granted, not everyone wants to go through divorce and so forth. But nonetheless, the lessons here in this regarding tax deductions, high interest rates versus low interest rates are applicable to many, many different situations we're dealing with today. So if we look at in a divorce, usually one spouse wants to keep the marital home, and current interest rates as they are, as of the recording of this, are higher than they have been in many, many years. And the current interest rate on the underlying mortgage is quite low, then oftentimes it's going to be the feeling like we need to keep that underlying mortgage, despite the cost to the negotiations and so forth. So it may not feel wise. A loan assumption may work, but those are not granted very often, and they're very difficult to get and they're long and timely and cannot be counted upon. Oftentimes there's an equity buyout, meaning that one spouse wants to buy out the equity from the other spouse. But we do know that moving to a higher interest rate on the underlying mortgage is going to hurt the cash flow of the person that remains with that mortgage. And of course, when we go from a joint filing situation to a single filing situation, or even head of household, the tax filing changes. And now that interest rates are higher than they've been in many, many years, that's a much different number, which we're going to talk about here in a moment. So the big question is there a way to mitigate higher interest rate through tax savings? And the answer is yes, pretty much. So let's just quickly compare the difference between standard deductions and itemized deductions. So in the current tax year over here, so last year in 2022, if you were a single filer, it was 12.9. Now it's 13.8. Married filing jointly was 25.9. Now it's 27.7. So pretty high for a married couple. And here's the numbers for head of households. But when you go back to single, right? So when someone gets divorced, their tax status changes from married couple at 27.7 to 13.8. All of a sudden, what opens up is the ability to go from the standard deduction, which is deduct a set amount from your taxes, to the itemized deduction, which includes all these other kind of things over here: medical and dental, mortgage loans, and so forth, charitable donations, and those types of things now become deductible. Right. So if we just look at someone who's got $84,000 in standard income, and in income, and here's standard deduction on the left-hand side and itemized deductions on the right-hand side. Gross income of $84,000, standard deduction is $13.8. Their adjusted gross income is $70,000, which means they have taxes owed of about $10,741. But if they're able to itemize now, all of a sudden the itemized deduction goes up to $20,000, reduces their taxable income to $63,000, and their tax burden is now $9,200. So they're saving about $1,500 in taxes they owe to the government. So let's talk about a quick scenario how this might apply. So wife wants to retain the marital home. There's no equity buyout, and they want to think about a qualified assumption because they want to hold on to that low 3.5% interest rate. Here's the current payment, taxes, and they also have an auto loan. The auto loan here is about $15,000 balance. So the total outgoing cash flow is around $27.38, and total debt between the current mortgage and the car loan is about $387,000. So we're going to look at kind of three different things: current situation, the standard rate and term, just paying off the existing mortgage and taking the other spouse off the title, or debt consolidation. Does that make any sense either? So the single rate and term refinance, getting the other spouse off the title, increases the cash flow by about $517. So not an ideal situation. Over here, then, if you did include the car loan, then now we have maybe an increase in cash flow about $319. Again, not ideal, but maybe that's worthwhile to kind of clean up the situation and make it all work. So let's annualize this now. So if we come through kind of this entire scenario, you see like the interest paid in this example, if they don't refinance, is about $15,500. The remaining spouse is able to get an assumption at $15,500. But if they do refinance and now they go to this higher interest rate from 3.5 to maybe 7.25, the interest paid during that entire year is about $27,000, and over here about almost $28,000. And again, an increase in cash flow of $517 and $319, but a significant increase in the amount of that money going towards interest paid because of the new mortgage amount and the higher interest rate. So now let's kind of come back through here again and look at the tax deductibility of all this. So if the current situation, if they do the mortgage interest tax deduction and so forth, come all the way down here. So the current situation doesn't change at all. The gross income is adjusted and so forth. Their monthly savings for this there's no monthly savings because that's the current situation. They did do the rate and term. Now all of a sudden their adjusted gross income is reduced because mortgage tax deduction went from $15,500 to $26,800. That results in a net savings of $208 a month. And over here, again, a little bit higher mortgage. Remember, this is a consolidation where they pay off the debt, $228 a month in tax savings. So what have we done? So bottom line, we come all the way back down here, again, comparing the assumption on the left, rate and term over here, just getting the other spouse off the property, or debt consolidation where they include the car loan. This is now with a change in tax status, about $412 a month, or over here, about $200 a month. So the question really comes back to then, so what's the situation? This makes it really clean. You don't have to worry about the assumption. There's going to get done. There's a rate and term. The refinance gets done. Title is cleared up, and we don't have to deal with this kind of moving forward. And that's about $200 a month. So much more palatable than sort of the other alternatives. So what's more important? Is it interest rate? Is it family cash flow? Is it looking for creative ways to accomplish a goal while minimizing the impact? That's the goal of what we do in mortgage planning and around divorce mortgage planning specifically. A lot of different factors affect cash flow, and solving for the big picture of this family is, of course, a priority. And all this takes a really strong divorce team when you're working through it, which includes the mortgage and the other members of that team, financial planners and tax professionals and so forth. And of course, keeping an open mind is always great because every situation is unique. Thanks very much, and I hope you learned a little bit of something in this Borrow Smart lesson. And if there's anything we can do to help you out, let us know anytime.